Welcome back everyone, Sean Stevens here again with Metroplex Mortgage Services and another USDA Loan Pro video quick tip. Do you know what payment shock is and how it can affect USDA loan qualifying? Understanding payment shock is important for both first-time homebuyers and previous homeowners that are re-entering the purchase market. Today's video tip will discuss and explain how payment shock can affect USDA loan qualifying. Well, what are we waiting for? Let's get started with the details. Payment shock is a difference between your current housing expense and what the new housing expense will be. For example, if you are renting, then we would compare what your current rental payment is versus your new mortgage payment, which would include monthly amounts for your principal and interest, property taxes, homeowners insurance, the USDA monthly premium, and any maintenance or association type fees. Remember, even though fees such as homeowners association or special maintenance or community costs of any type will not normally be included with an escrow account, they will still have to be counted towards both debt ratios and the payment shock calculation. Payment shock is a risk layer that underwriters will review and take into consideration during the loan approval process, and it is calculated by dividing the new total housing expense by the current rental payment, or in the case of a mortgage, existing total housing expense. Payment shock can be a factor on any loan that goes above the USDA published guidelines for housing expense, which is currently 29% of an applicant's gross monthly qualifying income. In the case of a first-time homebuyer who is trying to qualify for a USDA loan but may live at home rent-free, any new mortgage payment will automatically be at 100% payment shock since you are going from no verifiable rent history to a new mortgage payment. Now let's take a look at another example to help illustrate. Mr. and Mrs. Smith have been renting for the past year, and the current monthly amount is $700. The home they have found will have a new total monthly housing expense of $850. Step 1. Take the new housing expense of $850. Divide by current rental payment of $700 equals 1.214. Then subtract 1, which leaves you with 0.214. 0.214 is the same as 21.4%, which would also be the number used for payment shock in this scenario. Okay, I know what you may be thinking. What happens when the new housing expense will actually be lower than the current rental payment? In this case, you have a situation where there's actually negative payment shock. As I've mentioned many times before, in order to get credit for either low, no, or negative payment shock, we must be able to actually verify rental payment history. This can be done through canceled checks or verification by either a management company or apartment complex. It is important to not let these details overwhelm you. That is where we come in to help. As a USDA approved lender, Metroplex Mortgage Services holds an expertise in this unique program and can walk you through the USDA qualifying process step by step. We are here to help on your next pre-qualification. Just call or email to discuss your scenario and let us show you the Metroplex difference. Don't forget, we're known for keeping realtors and homebuyers updated through each step of the process, from pre-qualification through closing, along with one easy point of contact. Remember, these video tips are made for sharing. You can always forward with the social media links to the left, post on Facebook, and your comments below are always appreciated. I want everyone to make it a great day and look forward to seeing you right here for the next tip of the week.